Hi everyone, and welcome to our evening webinar on 10 tips to maximize your tax refund. Hopefully it's not a text seminar that will send you to sleep nice and early, and hopefully everyone gets a lot of good and useful tips. So we've kept the topics tonight reasonably broad because obviously everyone who's tuning in, everyone's in a different situation. So as we go through tonight, there's a little text box in the webinar program. So if you've got any questions, we do have everyone on mute, but you can type them down there. Depending on the question, I might be able to answer it as we go. If not, I'll try to address them at the end. So now, if anyone's got questions which are quite particular to your circumstances, feel free to reach out. My contact details will be at the end of the webinar. And they'll also be sent out to you guys in a little bit. For those people who've already got my details, feel free just to send me a message after the webinar if you've got some questions and need me to clarify things, how they relate to your personal circumstances. So anyway, let's get into it, guys. So tax is I find it an incredibly interesting topic, but it's incredibly complex. And when I was studying tax law at university, it was just absolutely amazing the fact that the Crimes Act, which is a list of every single crime that you can commit in New South Wales, is about an inch thick. Yet the Tax Act comes in 2-inch volumes, and there's 3 of them. So there are so many complexities and so many nuances that it really is impossible to know everything about it. So quite often when I talk to people about their finances, I talk about things being logical and reasonable, and the only time that never applies is when it comes to tax law. So now, of course, tonight it is general information. Everyone's got different circumstances. So as I said before, if you've got anything that you need to ask, just reach out afterwards, and I'll be happy just to give you a call and talk to you about how they apply to you. So we are coming up for tax time. So in about a month, you're going to be able to start submitting tax returns. You do have until October this year if you do it yourself. You've got around until May next year if you're doing it through an accountant. And general rule of thumb, if you owe the money to the ATO, you leave it as long as possible. If you're going to be getting some money back, you probably want to jump on things straight away. Now, normally when you do your tax return, you think about it, you think about it, you think about it. Your accountant will send you a list of, please supply these documents. And then you start searching for them. Now, one of the best things you can actually do is start getting those documents together as soon as possible. So now it's a little bit late in the financial year to talk about what we could have done over the past 11 months. But there's a whole multitude of apps out there and different programs to track things. And it's almost inevitable that when you do your tax return, you're going to forget something. So it could be something as simple as a meal you had just after visiting a client, or when you're out at away from your office. It could be ink you bought for your printer at home, which you use to print up the occasional work documents. So there are so many little things that we do through the year, and when you rush to get all the documentation together for your tax return, when you're dealing with your accountant, then it's quite likely you're going to forget something. So getting all your documentation together as early as possible just allows you to just find little bits and pieces over the next couple of months and make sure that you're less likely to miss things. It's quite common when we're talking to our clients about their tax returns that there might be a few hundred or even a few $1,000s that just gets forgotten every now and then, and that really does add up over the years. So as far as apps are concerned, quite often the good apps that you can use coincide with cash flow and budgeting. So things like My Prosperity, which we use, things like Pocketbook, which a number of our clients use. If you're running a small business, obviously, a Xero or your industry specialized accounting platform will help you to keep on top of everything. But key thing really is don't think tax once a year. Whenever you do anything, the shoebox, it actually does work. So just keep track of it through the year, and that'll help you guys to claim a lot more. You're always better off asking if something is deductible rather than assuming that it's not, because even if the entire amount is not deductible, it is actually quite possible that a proportion of it might be. So don't throw those receipts away, or don't forget those purchases. So now, coming up to the end of financial year, a lot of it is about spending money on things which may give you a tax deduction. And one of the time-honoured ways of saving on some taxes to salary sacrifice. Now, normally when we talk about salary sacrificing, most people think about superannuation, because that's the most common thing that people will salary sacrifice. It is certainly something that's going to help a lot. So depending on what tax bracket you're in, the mathematics just stacks up incredibly well. So when you're putting money inside superannuation, for every $100 that you earn, you might take home 60 after tax. If you put that into super, you get to keep 85. So straight away, that's $25 more, or around about a 40% return on your money. That's huge. Nowhere can you get 40% risk-free on your money after tax, after just a day. So getting extra money inside your superannuation is a great idea. Now, for a lot of people, they might only have 1 or 2 pays left. There might be a bonus coming through, so you can talk to payroll about maybe salary sacrificing a little bit of that as well. So not only do you save tax, obviously the major benefit at the end of the day is you get to make your superannuation grow a lot faster, and then you do get the benefit of compounding. So not only do you have more money because you've saved tax, you also get to make more returns on that money. So definitely a very good idea. Now, there is only a month for this financial year, but obviously everything which you learn coming up to the end of this financial year, you can apply next year. So if you're not putting in your maximum contributions to super, I'm certainly not saying that that's the right idea for everybody, but tipping a little bit more can be a very, very good idea for you. One thing which a lot of people don't realize is that your employer may allow you to also salary sacrifice other things. So there's nothing stopping you from reaching out to your employer, and if you have to buy a new mobile phone or a new laptop, pay for some courses, do those kind of things, you can actually salary sacrifice those. Now, by salary sacrificing, if your employer will allow you to, you don't have to worry about work apportionment, which means you don't have to say, I'm going to claim half my phone, because 100% of it will be paid with before tax money. But you also get the benefit of the company will be able to claim the GST on it. So not only do you get to use pre-tax money to buy a laptop or a phone, you also get the GST back as well. So that's a good little savings tip, and especially when you're looking at things like mobile phone contracts. When you add up how much money you spend over those 2 years, it's a fair bit. Buying a phone outright sometimes works out to be better, but if you can buy that phone with pre-tax money and get the GST back, sometimes you're a lot better off not going on a contract, getting a cheap plan and buying the phone outright. So we were talking about superannuation and the fact that there's only a month left to go until the end of financial year. So you may not be in a position to put all the money into superannuation that you want. So thankfully, some of the rules have changed over the past couple of years, and before, only self-employed people could put money into superannuation and claim a tax deduction, but that is now open to everybody. So even if you're an employee on a normal salary, when you get closer to the end of financial year, if you have a look at how much you've put into your superannuation and you feel that you probably could have done a little bit more, you can actually contribute your own after-tax money into super and claim a tax deduction on it. Now, that's exactly the same as salary sacrificing it, and what it means is you've got the control of the amount and the timing. So now moving forward next year, you'll also have the benefit of catch-up rules, and what that means is if you didn't put in the maximum this year, you can put in the maximum next year plus any amount that you didn't use this year. So just keep that in mind, and then that will roll over for 3 years. So the year after, you'll be able to use this year's unused amount and next year's. Now, obviously, it helps develop your super, which I'm a huge fan of, but you don't want to be putting all your money in super if there's other things that you want to be doing. So now on the other side of the scale, if you're earning less than $37,000 per year, you may not want to claim a tax deduction on the money that you put into your super fund. So if you're earning less than $37,000, if you put $1,000 into your super fund, then the government will match a further $500. So that's a 50% return straight away, free gift from the government. We don't get too many of those these days. and that's going to boost your superannuation. Now, if you're earning less than $37,000 per year, then the tax deduction that you would have gotten by putting money into superannuation would have been hardly anything. So that the $500 top up from the government is a really, really good idea. So now splitting with your partner, it's not quite what it sounds like. So it's quite common in relationships that you might have someone who has a larger super balance than the other, and you might have someone who has a higher income than the other. So what happens these days is when you hit retirement, you're only allowed to have a certain amount of money in tax-free assets inside superannuation. So at the moment, it's sitting at $1.6 million. So it's quite common that I meet people when they're closer to retirement that someone might be close to the 1.6, they might be over the 1.6, and they might have a partner who either had a lower paying job, or they didn't make salary sacrifice contributions over the years, or they're self-employed and they didn't make contributions, or a multitude of other reasons. And we have the situation then where we have one person who has, say, 2 million, another person who has only 200,000. Now, the difficulty there is the person with the lower balance, all of that money is completely tax-free when they hit retirement. So they can pull the money out, they can leave it in there, they can invest that into anything they want to, and any returns they get are completely tax-free from the age of 60 onwards for the rest of their life. Now, the person who's got the higher balance above 1.6 million, the first 1.6 million is tax-free and they get all the same benefits as what their partner does, but the remaining $400,000 is taxed. Now, admittedly, it's only taxed at 15%, so it's not the end of the world, but still, why pay tax when you don't need to? So what you can do is to preempt that kind of situation, that you can have, it really is like having your cake and eating it too. So if you've got a situation where you have a partner who earns more than you, or if you earn more than your partner, rather than your partner who's on the lower tax bracket contribute extra money to their superannuation to build that balance up, you can contribute, or the partner who earns more money can contribute more into their super and get the bigger tax deductions. And what we can do is we can allocate their contributions into your fund. So what that means is the person with the lower balance gets the money, and the person who pays the higher tax gets all the tax deductions. That really is about as close as you can get to having your cake and eating it too in tax land. So keep that in mind, and it's something that the sooner you address it, the easier it is on an ongoing basis. And eventually what happens is you get two funds which are of equal level, and then instead of having to allocate 85% of the contribution from one fund to the other, you can just split off little bits every single year, and then those balances just rise nice and carefully and evenly. So in that situation there, in the current tax environment, you can have $3.2 million tax-free in retirement, which if you've got more than 3.2 million in retirement income streams, paying a little bit of tax probably isn't the worst thing in the world for you. So home office expenses. Now, this is something which has been in the media a fair bit over the past couple of years, and the ATO have been talking about cracking down on home office expenses. So this is not a trick or a workaround. This is just explaining how the rules work. So what has happened in our society is there has been quite a massive boom in the number of people who have flexible work arrangements. There's been a massive increase in the number of people who have home-based businesses, people who are self-employed, the gig economy, freelancing, all those kind of things. So it is more common today than at any point in history that there's going to be a computer, a laptop, a printer, a scanner, an internet connection which is used for work, where you might sit there and answer emails, you might type up documents. If you work from home, you might be doing some video conferencing from there, but it's becoming increasingly common that we spend some time at home working. So as a result of that, most of us do have at least a little bit of a home office. So now one thing to keep in mind is it is an area that the ATO targets. So we do tell people to exercise caution in this area. But if you do 1 day a week or 2 days a week or 3 days a week and you work from home, you've got a dedicated space, you are generating income from your home. So in that situation there, you most definitely have a home office. Now, if you check the email on your mobile phone, for example, look up a couple of sites when, at the end of the day, you can't really say you're working at home. You're not really generating income. And if the ATO does look through your documentation and your history, they're not going to be particularly happy. So you really have to have not necessarily dedicated space. It could be the dining table. That's actually acceptable. But you have to generate income at home. You actually have to do bona fide work of a material nature while you're in the confines of your house. So if you feel like you can make that test, then you can look at apportioning some of the costs of running a house as a work expense. So obviously, if you're self-employed, that's a lot easier, because for some people who are self-employed, their main business premises is actually their house. And in that situation there, you can apportion a lot more. But even those people who are not home-based businesses, if you do genuine bona fide work at home, you should be able to claim some of that. So a couple of the easy ones you can do, you can look at things like your power, your internet connection. I've got a client who works in media, so he claims his Netflix because he actually watches that for work. I'm sure there's a bit of pleasure in there for him as well. Your water, even a small proportion of tea and coffee perhaps can be claimed. So now if you're a renter, it's actually really, really easy, because you've got just a clear defined cost of accommodation. You don't own the place, and essentially the more you work at home and the more space you dedicate towards it being your work premises, then the more of your home you're going to be able to claim as a tax deduction, and therefore some of your rent. So it's quite common for some of our clients where they will rent a house with an extra bedroom because they're running a business from home. So they are actually incurring additional costs for running a business at home. So claiming your rent as part of your work expenses is perfectly acceptable. So now where it gets a little bit tricky is when you own the home. So the rules are perfectly fine with regards to apportioning a part of the cost of running the house. That could include the interest and the interest on your mortgage and your rates and all those kind of things. So that's all perfectly fine. But one of the key things you've got to be really, really careful of is that your home is exempt for capital gains tax. So what that means is when you sell it, you don't pay a cent of tax regardless of how much money you have made. But if you generate an income from your home, then that ceases to be exempt from CGT for the proportion of which you've claimed. So if you said 10% of my home is a business premises and you make a $100,000 gain on your property, you'll pay tax on $10,000. Now, at the moment, you'd have to do the numbers and work out, well, the money you get back from tax by claiming that, how does that compare to the tax you'd pay on the capital gains? Sometimes it's worth it, sometimes it's not. But it does muddy the waters a little bit, so you just have to be a little bit careful around that one there. Same thing goes for when you're renting your property out on places like Airbnb. So just keep that in mind when you're doing your home office expenses. So for things like that, when the ATO are actually watching, you're probably best to err on the side of caution and make sure that you're not pushing the limits too much. So prepaying expenses. So one of the key things about tax when we do tax planning for people is a lot of it is about timing. So if you've earned the income, you've earned the income. But you can earn the income in the next year if you can push a payment out. And the same thing goes for expenses. So sometimes you've got the ability to either have an expense paid a little bit earlier or push out an expense a little bit later. And this is where we can certainly get a little bit of tax arbitrage. So one of the favorite things that we really love to do is when we have a situation where someone is stopping full-time work, whether that be maternity leave, whether that be starting up their own business, whether it be moving overseas, or whether it be retiring. And those are probably the most common ones. Now, what happens is, say you're earning money this year, say you're earning 180 grand this year, you're paying a lot of tax, and then come July 1, you're not going to work for a year. So anything that you pay for this year, which is tax deductible, you get almost half of it back. Next year, however, anything that you buy which is tax deductible, you don't get anything back because you haven't paid any tax, so therefore there's nothing to offset it against. So if you have expenses next year and you're going to be earning less next year than what you're earning this year, then a really, really good idea for you to consider is what of those expenses could you pay for early? And this could be things such as insurance. You can pay an annual premium for your insurance, things like income protection. If you've got a work car which is used predominantly or exclusively for work, you can prepay the comprehensive insurance on that. You've got subscriptions that you can pay for early. You've got office equipment. If you're working this year and you need to buy ink for your printer, paper, stationery, all those kind of things. If you've got business travel that you want to do, and next year you're going to earn less money than you will this year, prepay the flights. There's lots you can do. Other things you can also do is if you have investment debt, you can prepay the interest. Now, there are ramifications of this as well. So one of the things about prepaying interest is not a one-off expense. So you pay it every single year while that loan exists. And what you don't want to do is put yourself in a situation where you've prepaid the interest, so you've got lots of tax deductions, and then next year you've got nothing. So that's just one of the things you have to be a little bit careful about. If you're retiring, for example, that can certainly be a very good idea. If this year you had a massive income boost, whether it be a bonus or something that you've sold, then again, pulling forward things like interest on your investment loans will allow you to increase your deductions this year. And that's especially helpful if any of the extra income that you've got this year is pushing you up a tax bracket. So even though you don't get the deductions next year and you end up paying a little bit more tax next year, if that's going to help you come down a tax bracket this year, then that certainly can be something really, really useful. So now, if you are retiring or set up your own business, one of the things to keep in mind is prepaying things means you don't have to pay them next year. So it can help with budgeting. It can take a little bit of financial pressure off you as well. So trusts. So trusts they're in the election this year. So no changes. No changes in that situation there. So family trusts. They're often spoken about. They can be quite creative and magnificent from a taxation point of view. A lot of people ask me, should I have a family trust? Usually it's more often, no, it's not a good idea. When you do have a trust, you need to know how to operate it properly. They're complex vehicles. There are a whole different set of rules for how trusts operate. You do get the benefit of being able to distribute income through your trust to anyone who is an appropriate beneficiary. That can be kids, that can be siblings, it can be other family members, it can even be business associates. And you do get the benefit of being able to distribute income that you may have personally paid tax on at a higher tax bracket and distribute to people who are on a lower tax bracket. But every single year when you do that, you need to make sure it's all documented properly and you've signed all your declarations. Because if you don't, failure in the ATO's eyes is a 47% penalty, which is a lot of money. So you just want to make sure that you get all your documentation right with your trusts, and that you sign your minutes, you've got everything in order. Now, another thing which almost everybody forgets is understanding your beneficiaries' income plans for next year. So take an example, you distribute money through a trust to your retired parents. That may seem like a really, really easy thing to do, but what if they're 66 years of age and they're expecting to get the age pension next year? So you might turn around next year and say, Mum, Dad, I need to distribute some money to you, and they'll turn around and go, but you do that and we lose our pension. And they may not be particularly happy about that. So it's always a good idea that if you have an active participating beneficiary inside a family trust, that you have a dialogue with them and you actually understand what's happening in their life. So rather than just assuming you can keep on just using them to distribute money to and paying less tax, just check that things aren't changing. So they might be selling an asset and having a big tax year next year with lots of capital gains. They might have the age pension. They could have any number of things going on. They could be trying to divest assets, so they will go below a pension threshold, and you giving them income certainly isn't going to help that. So what that means for this year is it means that you might consider, if next year is going to be a bad year for distributing to your beneficiaries, you might look at, can you distribute more money this year maybe pay a little tiny bit more tax, but that allows you to get the money out of your trust a little bit quicker, and you may not face the same pressures next year. So that's particularly easy to do when you've got business income and dividends, a little harder to do when you've got active income like interest and rent from properties and that type of thing. So capital gains tax. So it happens to everybody. You sell an asset, hopefully it goes up in value, and you're gonna have to pay tax on that. So it could be on shares, it could be on property, but it can also be on other items. So business assets, for example, that you've written off but have actually got some carrying value. It can be collectibles, artwork, those kind of things, depending on your tax status. So now it's quite common that people will have to divest an asset, and whether that's because you're changing phases in your life and you're moving from a growth to an income phase, whether you're paying off debt, whether you want to go buy a home and you need to sell some of those shares or investment property. One of the key things when managing your tax for those events is to take a broader view of your circumstances. So a lot of people will just look at the asset itself. I've sold a property, I've made $200,000, I'm gonna have to pay tax on that. And the tax on that could be anywhere up to around about $47,000. So if you happen to have some shares sitting around that you purchased a few years ago and they've dropped in value, if you have a property that you're intending to sell at some point but you just haven't gotten around to it, and selling property for a loss is an incredibly painful thing because people get just obviously people get upset about losing money. But one thing is about things like properties, because they're such large assets, they're not the kind of things you can just buy and sell easily. But if you do have assets sitting on your balance sheet that are at a negative and you have lost money, have a look through all of them. If there's any assets in there that you really don't want to have on your balance sheet, that you've been ignoring a little bit and thinking, well, they're down, they're probably not going to come back up, but I just don't want to pull the trigger on that one there. Selling an asset that's lost you maybe $100,000 that you've got very limited prospects for getting profit from in the future. Well, if you sold that in the same financial year as making a $200,000 profit on your other asset, you'd actually halve the amount of tax that you would pay on the profitable asset. And in that situation there, that's saving up to about $23,500. So that's actually a way that you can gain a little bit back from something which has lost some money. Now, one thing to keep in mind with regards to capital gains tax is there's a couple of unique rules wrapped around that. So if you sell an asset and it's lost money, then you've got a capital loss. And if you've got no other capital gains in this year, you can bank that loss and you can keep it for any time in the future. So say you do sell some shares or a property and it's down 100 grand, you can just put that in the bottom drawer and that'll stay there until you have a capital gain. So you can only offset a capital loss against a capital gain. Now, one of the things to be aware of is you can't do it the other way around. So what I mean by that is if you make a capital gain this year and then you sell the asset next year for a loss, you don't get the benefit of that loss to offset the tax that you paid this year. So if you've got a loss on the balance sheet, try to balance them up. If you're not sure, get in touch. We can help you to assess whether or not it's worthwhile selling an asset. But you've got to do them either in the same financial year or get your loss first, because if the loss comes afterwards, then you've got to wait for your next gain, which could be quite a number of years if you're not selling anything. So number 9 is depreciate your property. Now I meet a lot of people who come in here and they've got an investment property. It might be a few years old, a little bit tired, and quite often I'll ask, have you done a depreciation schedule on this property? More often than not, people go, no, it's too old. So unless you've owned the property for 40 years and you know for a fact that you haven't spent a cent on it, then on the balance of averages, there's probably going to be some depreciation on it. So if you have a home that you lived in and you've moved out and you're now renting that property out, and this is, I guess, one of those freebies which work quite well, is that you can depreciate the house that you used to live in. Now, you get 6 years of renting that property out on the market to be able to sell it without paying any capital gains tax. But again, it's just one of those things that people forget all the time. Now, depreciation can be anywhere from a few $100s per year to $10, $15, sometimes $20,000 per year. So the way that it works is someone goes in, they have a look at the total property, and they divide it up into key components, which is effectively the building component, which is your bricks and your mortar, and your structure, your frame, and then they depreciate that over a 40-year time frame. And that's where a lot of the misunderstanding of depreciation comes about, because a lot of people think, well, if the property's older than 40 years, I can't depreciate anything. But on the balances of averages over a 40-year time frame, you've potentially replaced the roof, you've potentially replaced the kitchen, it's probably got new carpets, it's probably had painting done, it's got new appliances. There's a lot of stuff that happens to a property over its lifetime. So typically you get someone in there, a quantity surveyor, to do a depreciation report, and there's a very, very good chance that you are going to be able to claim some depreciation. So that could be worth quite a few thousand. The depreciation reports typically will last up to 40 years, depending on the age of the property. Quite often after around about 10, 12, 15 years, most of the depreciation has run out. But we're talking potentially thousands of dollars of depreciation for 10, 15 years. So the reports generally will cost you anywhere from $300 to $700, depending on where your property is, what type of property it is. There are some companies out there that actually offer a money back guarantee that if they can't find enough depreciation for you to claim to make enough to pay their bill, then they'll give it to you for free. So quite often you've got absolutely nothing to lose. So any properties which are investment properties which you haven't depreciated, definitely get a depreciation report. Any houses that you've lived in that you're now renting out, definitely get a depreciation report. It will potentially make you thousands of dollars. So now the final one, tip number 10, is small business deductions. So if you are running a small business, you do get the benefit of what's known as a $30,000 instant asset write-off. So what used to happen is if you bought anything above $1,000, you'd have to depreciate it over a number of years, and that's the working life of that item. So things like computers, you buy a laptop for a few thousand, you have to claim it over a number of years. So to stimulate the economy and get us all spending money that we don't have, the government decided to introduce the instant asset write-offs, and that means that it used to be 20, then 25, now it's 30,000. So you can go out there, buy a $30,000 business asset. So you can go buy yourself a ute or a van or new office furniture or anything you want, and you can write that off straight away. Now, the hidden danger in this one here is what happens if you didn't need to spend the money? So one thing to keep in mind is most definitely do not spend the money unless it's something that you need to buy. So if you need to buy some business assets for your small business and you're thinking about buying them in July, then maybe it's a good time to sit down with your accountant and have just a quick look at your end of financial year figures before we hit June 30, simply because if you're sitting in there with a little bit of profit and you're going to go spend some money in July, what you're better off doing is, and just to give you some mathematics around it, say you are going to make a $30,000 business profit this year and you've got two $15,000 business assets that you need to buy in July. Just by buying them in June allows you to write off all of your profit and reduce your tax by about $8,000 in this financial year. So that's $8,000 you do not have to pay to the ATO. You get your business assets a few weeks earlier than what you were going to originally buy them. You've got $8,000 more in your pocket, and everyone's happy. So it is a timing thing. But say, for example, next year you found other things that offset your profits and you weren't going to make a profit next year, then that's just $8,000 that you didn't need to pay to the ATO. So, but I really, really have to stress to you, everybody, not just the small business asset write-offs, but for anything at all which is tax deductible, do not spend it unless you need it. So it's a very, very common thing that I'll hear from friends, and I say, oh, yeah, it's okay for you. You can claim as a tax deduction. You still have to pay for it. So tax deductible just means you get a deduction on your income tax. It doesn't mean anyone else is paying for it. So if you don't need it, you don't buy it. So a $30,000 tax write-off sounds fantastic. I've already had a couple of phone calls from clients, and I'm sure I'm going to get a few more saying, should I buy a new car before the end of financial year? And of which the first question for me is always going to be, do you actually need a new car? 99% of the time it's, well, no, the one I've got's fine, but it's tax deductible. So only spend it if it's something that you definitely need to buy. And from a timing perspective, if you're thinking, yeah, I might buy it by March next year, then bring it this far forward, it may not necessarily be a good idea. It could be bad for your cash flow, your circumstances could change. So try to keep things, practical, and keep your eyes on the bigger picture. So anyway, so that's the top 10 tax tips. I've tried to give something in there for everybody. One thing to keep in mind is that there's just so much information out there, whether it be on the ATO site, on forums, in the media. Lots of good ideas out there, but as I said before, everyone's circumstances are unique and different, and it's really important that you get the right advice. So now, not everyone needs a complex tax plan. It could just be one email, one question, one phone call. But make sure that when you're looking at some of these ideas and some of these options, whether it be putting more money in your super, co-contribution, buying business assets, whatever it may be, just throw the idea out there and get a second opinion. So now, Financial Spectrum, as for those of you who know us, we do have a tax division. We've got half a dozen chartered accountants who sit here crunching numbers day in, day out. Don't know how they do it, but they're brilliant guys, and they can certainly help you guys with any of your tax affairs. So whether that be structures, whether that be lodging returns, and as I said, even if it's just an email or a question about whether something is deductible or whether or not you should do something, we've got a phenomenal team of people here who can help you out. So now, if anyone's got any questions, just down there on your screen, I think it might be over here actually. There's a chat section. So I'm just going to hang around for 30 seconds. If anyone has any questions, you can post them there. I did get one question before about who the ATO targets. So that's a the ATO puts out a list of who they're targeting every single year. It's fun reading because it kind of tells you who's going to be audited. But one of the key things to keep in mind with regards to the ATO is they have an absolutely phenomenal amount of data. So just a few years ago, they had 1 billion data points. And what that means is 1 billion transactions, whether it be bank accounts, invoices, transfers, credit card statements, whatever it may be. And in a recent report I read, they're struggling a little bit with that technology because they've now hit 20 billion data points. The ATO knows more about you than just about anybody. So they have access to all of the bank's data, all of your bank account data. They've got access to accounting systems. Airbnb, for example, is now legally required to supply to the ATO lists of every single property that's been rented out and how much. And they also know who's been renting them. And it may sound a little bit far-fetched, but they've even got a social media team. Okay, so now that's not a social media team who's sitting there taking Instagrams of auditors doing fun things. That's actually a team of people whose job it is to look at the tax profile of individuals and compare it to their social media profiles. And when there's a situation where someone is saying they earn $20,000 per year and they're a low-income earner, and you're sitting there taking Instagram shots in designer clothing and flash cars, you're probably going to get a phone call. So what they do is they've got the ability to understand what a normal person looks like. So if you're a lawyer, or if you're a teacher, or if you're a tradesperson, then they know on average how many deductions the average person is going to claim. So a tradesperson would claim this much as clothing allowance. A teacher would claim this much as education. So if you start putting deductions in there and they don't meet the criteria, their computer systems automatically spit your name out and pass it on to an auditor, where you'll get an email saying, could you please explain why you put this deduction in there? Now, if you've made a genuine, honest error and you've gone, oh, oops, I didn't mean to do that, typically they'll go, that's okay, just don't do it again, okay? If, however, you have really concocted a lot of stuff in there, and you try to hang in. You go, no, they're right. You're gonna get a phone call. You might get a visit. So just keep in mind that the ATO really is watching everything. If you've been quite aggressive with your tax, think about buying that flash car. Probably not a good idea. The ATO keeps a register of car registrations. So anyone who buys a car over a particular price point, and it's actually very low, anyone who buys a particular car over a price point is put into a database, and again, that is matched. And typically they know that people who drive Mercedes or Ferraris or any car really, what type of people and what type of income limits should be driving those kind of cars. And again, where there's a mismatch, it goes to a human and it checks that out. So now, if anyone's got any other questions, just throw them down there. If not, as we mentioned, we'll make the slides available to everybody. Now, if the stuff that I've gone through tonight does spark some thoughts or some questions, as I said, my contact details will be made available at the, oh, there we go, they're right in front of you there. So reach out, either jump on our webpage and go to the contact form, send me an email. If you've got my mobile phone number, text or call the office sometime tomorrow morning. We are always here to give you guys a hand and answer any questions. Little questions we can probably deal with pretty quickly, but anything a little bit more complex might get you in and have a chat about it. All right, everyone. Hopefully that was helpful for you.
Question: what are the top 3 things a higher band taxpayer can do?
So the top things a higher tax band payer can do. So, well, the ATO has been incredibly, not the ATO, the legislators have been incredibly aggressive of cutting down on all the things that anybody can do with regards to paying less tax. So people who are on the upper echelons of the earnings scale also have the added pressure of paying additional superannuation tax there as well. So typically in the really short term, there's not a huge amount you can do. So now if you're self-employed, you really should take a very hard look at your business structures, your trusts, your beneficiaries, your distributions, your dividend policy, all those kind of things. So for self-employed people who are on high tax brackets, there's a lot available to you just on the structuring front, but that does need a more detailed structured long-term plan. For those people who are PAYG and they're earning well above the high tax bracket, you're limited with what you can salary sacrifice because you've got your superannuation caps. You don't really want to go out there and spend heaps of money on things which are deductible. And what you really need to have a look at there is a longer term tax plan. So things such as maxing out your superannuation, looking at share portfolios with franked dividends, looking at properties with depreciation. But they're the kind of things that just build up bit by bit over time. So you do have the benefit of things which I mentioned before, such as prepayments. So if you've got investment properties, you've got a huge bonus this year, you might want to consider prepaying some interest. That can wipe off this year's bonus. But then we have the problem of next year's bonus, assuming that there is one for you. And then next year you'll have to prepay for another year. What you can do there is you can actually have a look at a longer term, more aggressive tax strategy of asset acquisition and using your tax dollars to actually fund buying more assets. But that happens bit by bit, year by year. But you will find yourself in a few years' time potentially moving yourself down a tax bracket. Do we have any other questions that you want to shout out there?
Can our tax team provide sophisticated tax structure advice? So
most definitely. If anything, it brings us joy and happiness. So the more complicated, the better, because we're tax geeks, so it's a lot of fun. So whether it be global taxation advice, structuring, family trusts, hybrid trusts, unique situations, multi-generational wealth transfer, whatever it may be, we're pretty much into most of it actually. So yeah, so if you do need a complex situation taken care of, certainly give us a call, and we'd be nerdily quite excited to hear about it. So anything else there?
No more questions.
Fantastic. All right, everyone. Thank you for tuning in tonight. We'll make the slides available to you guys tomorrow. And if there's any questions in the meantime, get in touch. It's great seeing you all. Have a good night.